Welcome. This is a banking sector special. The Nifty Bank was actually leading the Nifty in gains all the way up to June. But post the Q1 results, it appears to have lost its mojo. This month, that is in August itself, the Nifty is up only 0.5%. The Nifty is up 0.5%, while the Nifty Bank is down 1.5%, data as of Friday. Now, is this because of the results, or is it the series of rate cuts, or is it that credit is slowing down? To analyze the outlook of the banking sector, I'm joined by Rikin Shah, the Senior Vice President and banking sector expert at IIFL Capital. Rikin, thank you very much for joining me. Rikin was to actually join me in the studio because we were going to read out this excellent report that he put out last week. I mean, it's one of the most comprehensive and most brilliant reports I've seen. We would have loved to have you, but the rain is just impeding all movement in Lower Parel. Rikin, thanks much again. Well, first up, to cut to the chase, you're speaking about margins bottoming out by the second half. But there are a significant number of economists who believe another rate cut could come not necessarily in October, but maybe in December or in February. Have you factored that in? One or maybe even two more rate cuts?
Hi, good morning, Latha. Thanks for having me on your show. So answering your question on the margin outlook, given the full impact of the 100 basis point of the repo cuts that have happened, we are of the opinion that the margins start stabilizing around 3Q and then improve from 4Q. But that naturally doesn't take into account any additional rate cuts. Our house view at the moment is that we could potentially be looking at 50 basis points of total rate cuts in the next 6 to 9 months. And in that backdrop, if that were to happen, the financial year 26 earnings growth for the sector, which we are projecting it to be minus 5%, will further drop down and could be closer to minus 7 to minus 9% YOY earnings growth. But having said that, I think to provide a context, this is not a structural margin pressure. Whatever we lose in terms of the margins this year on account of additional rate cuts from here, we would recoup a lot of that in FY27 itself. So my FY26 earnings go down, but FY27 earnings growth would even look better when the liabilities start repricing with a lag.
Now, I take your point that, it's just that the deposits will start getting repriced a little later. But let me come to credit growth. You are a little worried about, everyone is worried about the credit growth in the current year, but this is pre-tariffs. Now, after tariffs, the expectation may not be that credit growth will necessarily pick up in FY27 itself. Is that factored in? What kind of credit growth and earnings growth are you therefore penciling in for next year?
Sure, Latha. So in terms of the credit growth, the currently banking system is growing around 10% YOY. We are of the camp that while there could be some modest pickup in the growth, it is unlikely to rebound very strongly. So our loan growth projection is only around 11%, and there are a few factors why we believe that growth is not likely to accelerate significantly. Number one, if we've done this study for home loans in India across the last 2 decades, counterintuitive to the common perception that when the rates go down, the home loan demand goes up, we have seen that the home loan growth actually decelerates when the rate cuts happen. It's not a demand issue, it's a supply issue for the banks because these are a very low margin and low ROA products. So the willingness of the banks or HFC to lend in lower rate environment is lesser, and hence the loan growth decelerates. The evidence of that is that already in this past few months, we have seen the banking system loan growth for home loans going down from 16 to 10%. So that's number one reason. The second reason, again, is the corporate credit growth. While the common perception out there is that the corporate credit growth in India is very weak, we actually argue that it's not weak at 9-10%. It's actually ahead of the long-term averages. But the problem is for the banks because banks are getting disintermediated by the bond markets and the NBFCs. And this is not a cyclical phenomenon. It's a structural issue that we are seeing. Banks have actually lost 20-25 percentage point of market share in last 10-15 years. So the large industry growth or the large corporate growth is also likely to remain tepid for the banks. And the final and the last point is that while cyclically we have seen the banking system loan growth being very strong in few periods, last 3-year, 5-year, 10-year, 15-year CAGR shows that banking system loan and deposit growth has always been between 10-11%. So we need to accept that the banking system loan growth is not likely to accelerate significantly. but it has bottomed down at around 10% currently.
That's a brilliant explanation. I am old enough to have known that in previous cycles as well. Home loans did not pick up when rates were falling, but actually when rates started rising. But that explanation is very good, that banks, don't like the home loan product because of the lower margins when rates are falling. What kind of credit growth are you penciling in at all in FY27? And are you taking into account the lower nominal GDP? For the quarter that will announce the GDP now, August 29th, the nominal GDP is expected to be 8.3%. The budget is looking at it at whatever, 10.5 or something. We're going to have a bad nominal GDP for the full year. So, what kind of credit growth this year and next?
So this year we are expecting the loan growth to remain around 10.5% YOY, and next year it only moves up slightly by 11%. The point on the nominal GDP is correct. The nominal GDP has slowed down for India. So unless the nominal GDP moves up, the banking system loan growth is unlikely to accelerate meaningfully. And I'd like to add one more point here. While we focus only on banking system, if we include all the other providers of credit, including NBFCs, bond, ECBs, etc., the total credit in India is actually growing at 13%. It's already healthy 1.3 times credit multiplier, and that's not a worry at a system level.
No, point taken. Actually, if you take the nominal at GDP at 8.3, then this is a 1.5 times credit growth. Point taken. Wait, I want to come to the big asset quality and MSME question, but people will be wanting to hear from you buys and sells. What would you bet? You're saying that valuations of the big banks are actually reasonable now?
Yeah, so Latha, what we have found is that calendar year to date, for the mid-sized banks, the earnings have been cut between 30 to 70% for even FY27, but they have re-rated sharply from distress multiples. On the other hand, if you look at the large banks, the re-rating has been very, very low. We are talking about only 5 to 15%. And in that context, when we look at next year, we are expecting high teens earning CAGR for the large banks. And the valuations are very reasonable, especially if you put that in the context of the broader Nifty. So the banks delivering high teens earning growth for 12 times forward PE. On the other hand, Nifty delivering only 13-14% earnings growth, trading at 22 times PE. The reward looks interesting from the banking sector from FY27 perspective. Of course, in FY26, there are still some more challenges that we need to get through.
Okay, got a point. Okay, Rikin, something separate from your report, I wanted to ask you. Since you referred to this mid-sized banks seeing a 20 to 60% rise in prices, why are you, prominent brokerages ignoring the likes of a BOI, a Bank of Maharashtra, an IOB? They've come from very difficult times and have shown a vertical growth. You all are largely ignoring that mid-sized banks?
So we do keep a tab of the mid-sized private banks, and we have liked some of the mid-sized banks even in the past few months. For instance, among the mid-sized banks, our preferred pick at the moment is even RBL. So depending on where we are in the cycle, how much stress they've gone through and what multiples they are trading in, we had been bullish on the mid-sized banks for last 3 to 6 months. But from here onwards, we believe that large banks, our preferred picks are ICICI, Axis, HDFC, and SBI. We are relatively cautious on Kotak. We think that the risk reward for them is more attractive. Mid-sized banks, here onwards, the price return will be dependent on earnings growth rather than valuation re-rating that we saw in last 3-6 months.
Okay. Yeah, I saw your valuation chart even for the likes of BOB and all. It is a little pricey compared to these banks. Now, very quickly on asset quality. We saw this very big rise in loans to MSMEs. Your own chart is showing that, ICICI Bank's MSME loan book, 29.5% rise. HDFC, I think some 17 or 19% rise. It's like fairly tagda compared to the overall loan growth. Separately, we saw Bajaj Finance absolutely bemoaning the MSME credit quality. So should we worry?
Sure. So we actually analyzed the bureau data, and if we split the MSME in 3 buckets, the entity MSME, secured individual business loan, and unsecured individual business loans, there are pockets of stress. The common underlining theme across the 3 segments is that the NBFCs, small finance banks, and the low ticket size loans are the areas where we are seeing early bucket and even the NPAs rising. So for instance, if we speak about the unsecured individual business loans, we have seen that stress in less than 1 lakh rupees and stress in 5 to 50 lakh ticket size has gone up. This is the segment which Bajaj Finance also operates in, and they alluded to stress in the last quarter that went by. But if we look at the entity and secured individual business loans, what we have noticed is that the large private banks are already operating at very low levels and are seeing improving trends. PSU banks, the stress has always been elevated relatively for them, but directionally they are not worsening. It's NBFCs and small finance banks where the bulk of the stress is becoming visible, and that's one segment we'll like to operate. But clearly, large banks have also grown. I would like to comment that unsecured retail credit stress is largely behind us or will get behind us in the next couple of quarters. But next pocket to watch closely would be MSME or the lenders.
Oh, yes. I'm just worried, there is this export worries looming. Not all of them are borrowers, but some of them are. But let's hope, fingers crossed. Unfortunately, out of time, Rikin, but once again, many congratulations for an extremely useful and overarching, comprehensive report on the banking sector performance. That's it on this edition of Bazaar and, banking sector analysis. Chartbusters coming up after a break.